and good morning or evening to everyone, and thanks for joining us today. To put it simply, Novelis' 2019 full-year operational and financial results were outstanding. And I want to thank my colleagues and our customers for their many contributions in partnership to achieve them. These include records across key financial metrics from shipments to EBITDA and free cash flow. Adjusted EBITDA grew 13% year over year to $1.4 billion. This is up over 50% compared to where we stood just 5 years ago, an 11% compounded annual growth rate. This year, we further improved operational efficiencies and delivered innovative, sustainable solutions to our customers to capture growth in our key end markets. And we took a number of important steps to increase and enhance our capacity and capabilities through targeted strategic investment. We continue to make progress on our strategic journey to defend our core businesses, strengthen our product portfolio, and invest in growth opportunities. And we did this while delivering on our purpose of shaping a sustainable world together by achieving key sustainability targets across the value chain, benefiting our customers, partners, and the communities where we live and work. Deb will cover our financial performance in a moment, but first let me spend a few minutes getting into each of the other highlights listed here. Turning to slide 4, I'm proud of the hard work and many contributions by our employees across the organization as we continue to make progress against our operational excellence goals. With this focus, we are improving product quality, managing costs, and unlocking capacity. Safety remains our top priority at Novelis, and we are achieving rates at industry-leading low levels. With safety front and center in fiscal 2019, these metrics continue to trend in the right direction, but we will always continue to do more. We also improved recovery rates on many of our machines, leading to incremental capacity release and contributing to record shipment levels this year. This will continue to be a focus in fiscal 20 as well, because when the machines are running at full capacity, every additional ton that is produced yields a higher margin. We also remain committed to partnering with and supporting our customers as they grow by delivering high-quality products and excellent customer service. We improved our on-time, in-full delivery rates throughout fiscal 19 and are introducing new customer solutions in terms of both products and services. We made advancements that further the sustainability of our products and business. For fiscal 2019, the percentage of recycled content within our flat roll product shipments averaged 61%, up from 57% last year, and a 15% point improvement over the past 5 years. We also reduced our greenhouse gas emissions by 5% year over year, even as we grew our shipments and production levels. Sustainability is becoming even more important to consumers, our customers, and stakeholders, and I'm proud of Novelis' long-standing commitment to the sustainability of our communities and our environment. On slide 5, you can see that these sustainability initiatives don't stop with Novelis. We are partnering more and more with our customers across product segments to develop innovative and sustainable products and processes. For example, this year we partnered with Volvo to establish an automotive closed-loop recycling system in Europe to reduce CO2 emissions, decrease waste, and increase the recyclability of aluminum in the automotive life cycle. We continue to work with all of our customers to find innovative solutions to meet their evolving needs. For example, we are working with our can customers to collectively increase throughput. We also recently invested $4.5 million at our Warren, Ohio beverage can end plant to offer expanded BPA and I coatings and pretreatment options. We introduced our S360T aluminum alloy in the steel-dominated market of structural components for commercial vehicles to our specialty customers. And on the automotive side, we established 3 customer solution centers in Detroit, Shanghai, and Stuttgart, Germany. These centers will allow us to better collaborate with our customers during the decision-making process which further allows aluminum to compete more effectively against steel. Through these centers, we are moving beyond simply being a material supplier to a solution provider to help our customers lightweight their vehicles and achieve better performance. The first major achievement resulting from these new centers is our recently introduced aluminum sheet battery enclosure solution. Available globally, this innovative design for next-generation automobiles provides a more sustainable solution in battery electric vehicles, a market that is expected to more than triple in growth by 2025. Innovating to deliver the highest quality, technically advanced aluminum solutions to the marketplace is imperative. We are currently in the final development stages of a number of new high-strength alloys that will be launched later this year to complement our existing suite of lightweight, high-strength, durable, formable, advanced alloys. Turning to slide 6, we continue to see positive demand for lightweight, sustainable aluminum in all of our end markets, driven primarily by economic developments in emerging countries and material substitution. Starting with beverage can, fiscal 19 shipments grew 7% for the year. We remain committed to supporting our can customers globally as a core end market. Strong demand for beverage can sheet continues with generally favorable market conditions everywhere. Economic recovery in Brazil, growth in emerging markets, and favorable package mix shift are all supporting this increased demand. At this time, it is difficult to fully appreciate how much an increased focus on sustainable aluminum solutions may be playing a role in this increased demand. But the many positive qualities of aluminum beverage packaging, most importantly, perhaps its lightweight, infinitely recyclable characteristics, position us well to capture higher demand resulting from the growing worldwide backlash against plastic pollution. Automotive shipments continue to grow in 2019, although at a slower rate as we operate at higher utilization levels and saw some softness in the second half of the year in China. Our long-term outlook remains unchanged, with a global 5-year compounded growth rate in the low to mid-teens for automotive driven by continued material substitution trends towards lightweight aluminum. The U.S. outlook remains strong. Consumer preference for larger vehicles, which typically have higher aluminum content, continues to grow. Thus, the right mix of vehicles within U.S. auto sales forecast is in our favor, and we feel good about the outlook here. In China, a significant reduction in automotive sales is impacting our recent performance in this region. However, we do not expect this reduction in consumer demand to be prolonged, and in the meantime, we will utilize regional capacity to support stronger demand in the can and specialty markets. Overall, we understand automotive is a more cyclical business with greater exposure to the highs and lows of economic cycles, but generally we see broadly favorable market conditions here. Specialty sees continued steady growth in line with GDP. However, because we are facing some capacity constraints, we selectively reduced shipments 11% in fiscal 19 as we work to optimize our overall product mix. We can be more selective in the markets and products we supply. For example, maintaining a sharper focus in North America where market conditions remain quite favorable. Turning to slide 7, let me provide an update on our various strategic initiatives, including our pending acquisition of Aleris. Over the past 18 months, we announced 3 significant projects to increase capacity to meet growing demand around the world. All projects are progressing on time and on budget, with construction at all 3 sites well underway. First is the 200 kiloton Greenfield Automotive Finishing Line project in the U.S., located in Guthrie, Kentucky. This finishing facility will receive coils from our nearby Logan aluminum rolling mill. The building foundation was complete in Q4, and equipment installation is set to begin in the next couple of weeks. We look forward to beginning the commissioning process and qualifying coils at this facility toward the end of this fiscal year. The 100 kiloton automotive finishing expansion at our existing Changzhou, China facility is also progressing well. Recent milestones include the installation of cache bay roof panels and a pit foundation, all while completing 500,000 man-hours without an on-site injury. Commissioning on this line is set to begin in fiscal 21. Construction on our most recently announced expansions at 100 kilotons of additional rolling capacity and 60 kilotons of additional recycling capacity in Brazil has also begun. A new drop house to support the recycling addition has already been built, as pictured here. While commissioning of the complete project is set to begin in fiscal 2021, a new scalper head will be installed in the coming months to free up a small amount of rolling capacity as soon as this fiscal year. Lastly, as you all know, we announced in July 2018 that Novelis entered into a definitive agreement to acquire Alaris for approximately $2.6 billion. This is a significant acquisition for Novelis, and it will drive many strategic benefits, from integrating our Asian operations to drive synergies, to diversifying our portfolio, to broadening our customer base. We continue to work to clear the regulatory hurdles and are confident that we will close this transaction in the third quarter of calendar year 2019. Now I'd like to turn the call over to Deb for a more detailed review of our fourth quarter and full year financials.
Thank you, Steve, and good morning or evening to all of you. So we reported net income of $103 million in the fourth quarter of fiscal 2019 as compared to $106 million in the prior year. Excluding tax-affected special items in both years, as outlined in the back of our earnings press release today, net income was $130 million as compared to $101 million in the prior year. The largest of the items excluded is metal price lag, which was a negative $25 million in the fourth quarter of fiscal 2019 as compared to a positive $9 million in the prior year. The increase in net income, excluding special items, is primarily due to a 12% increase year over year in adjusted EBITDA to a record high $357 million. Net sales increased 1% to $3.1 billion, driven by an 8% increase in total flat-rolled product shipments to an all-time record 870 kilotons, partially offset by lower metal prices. We ended the quarter with further improvement of our net leverage ratio to 2.5 times. Slide 10 bridges the drivers behind the significant improvement in fourth quarter adjusted EBITDA. The biggest factor driving year-over-year improvement was the impressive increase in shipments in all regions. Higher total shipments driven by strong global demand and solid operational performance led to a $62 million benefit from volume. Overall, price and mix also contributed a net favorable EBITDA of $11 million, with favorable pricing driven mainly by better regional mix. Higher costs are primarily related to higher operating costs linked to a higher level of shipments and freight expense, partially offset by lower metal costs due to favorable scrap market conditions and a strong return on our investment in recycling capability. While we continue to see some favorable conditions in the scrap market in some regions, they have moderated from the levels seen in the second half of calendar year 2018, largely from lower LME metal prices and local market premiums. FX was negative $10 million, driven by FX translation in Europe and some hedge losses related to appreciation of the US dollar against the Korean won. SG&A and other was negative $9 million, primarily driven by higher employment costs. Turning to highlights for the full fiscal year 2019, we reported net income attributable to our common shareholder of $434 million as compared to $635 million in the prior year. Fiscal 2018 net income included a couple of large non-recurring items, such as a $318 million pre-tax gain for the 50% sale of Ulsan and a $33 million non-cash income tax benefit related to U.S. tax reform. Excluding tax-affected special items in both years, as outlined in the back of our earnings press release today, net income increased 12% to $468 million in fiscal 2019 as compared to $420 million in the prior year. Adjusted EBITDA increased 13% to a record $1.4 billion. On a per-ton basis, annual adjusted EBITDA has shown dramatic improvement over the past 5 years, growing $124 per ton over that time frame to $418 for fiscal year 19. Net sales increased 8% to $12.3 billion, driven by higher average local market premiums and a 3% increase in total flat-rolled product shipments. Shipments grew to nearly 3.3 million tons in fiscal 19, driven by strong beverage can demand globally and continued growth in automotive rolled products, partially offset by lower specialties shipments as we make portfolio choices to best utilize our capacity. We ended the year with a very strong liquidity level of $1.8 billion. Slide 12 bridges the drivers behind the 13% increase in adjusted EBITDA in fiscal 2019, which fall predominantly into two categories, volume and cost. The 3% increase in total shipments, driven by strong global demand and good operational performance, led to an $88 million benefit from volume. Overall, price and mix also contributed a net favorable $8 million to EBITDA, positively impacted by optimizing our product portfolio as we operate at near capacity levels. This is partially offset by the impact of previously negotiated lower-priced can contracts in the first 3 quarters of the fiscal year. Cost favorability contributed $98 million of EBITDA benefit this year. This includes benefits from operational efficiencies throughout the year, better metal mix as we better utilized our recycling assets, and tailwind from favorable scrap market conditions, more so earlier in the year, partially offset by higher freight expense and other cost inflation. FX was negative $10 million, mainly due to hedge losses. SG&A and other was negative $31 million for the year, primarily driven by higher employment-related costs, factoring, and other business and professional fees. Now let's turn to free cash flow on slide 30. We generated a record high $408 million of free cash flow in fiscal 2019. Free cash flow before capital expenditures increased $127 million over the prior year period to $759 million, primarily the result of significantly higher adjusted EBITDA. This strong cash generation is allowing us to delever and also fund increased spend on strategic capital expenditures as Novelis enters an exciting growth phase. Fiscal 2019 capital expenditures increased to $351 million as compared to $226 million in the prior year as we began spending on the 3 major strategic expansions that Steve spoke about earlier. While CapEx spend in fiscal 2019 came in lower than our guidance of approximately $400 million for the full year, this is simply a matter of timing, and all of our major strategic projects remain on track. With these strategic projects continuing into fiscal 20, we expect fiscal year 20 capital expenditures to grow to approximately $700 million, which includes $200 million for maintenance capital. At current aluminum prices, we will generate robust cash flow that will more than cover increased capital spending. This will result in a fiscal 20 free cash flow lower than fiscal 19, but that will remain significantly positive. So with this, I'd like to turn the call back over to Steve.
Thanks, Jeff. In summary, our strong financial year performance in 2019 is a result of our strategy to grow and diversify our business, our efficient operations, our focus on our customers, and broadly favorable market conditions. Demand for aluminum flat roll products remains strong across all key end markets in the near and long term. Our global footprint, diversified product portfolio, and strong financial profile have positioned us well to innovate and grow with our customers. We are making disciplined strategic investments, both organically through capacity expansions around the world, as well as through our pending acquisition of Aleris. I am proud of our operating and financial performance, our strategic actions to strengthen the business, and the development of sustainable products and services to offer our customers now and into the future. With that, I'm happy to take any of your questions.
Thank you. If you'd like to register a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. If your question has been answered and you would like to withdraw your registration, please press the 1 followed by the 3. One moment, please, for the first question. Our first question comes from the line of Jeff Kramer from Morgan Stanley. Please proceed with your question.
Hey, good morning, Steve, Devinder, Megan. Great to see another solid quarter.
Thank you.
Just on the shipments during the quarter, the 870 KT, just in the context of sort of the capacity constraints right now, do you think that's kind of sustainable from here? You think you could grow that from here? Just thoughts on that in fiscal 20.
Yeah, Jeff, it was an outstanding quarter, record shipment quarter. Obviously, we've done a lot, as I highlighted in my prepared remarks, around getting more out of our assets, and we're going to continue to do everything we can to get more out of those assets. And are confident we will. It's just hard to predict, when we can get some of those successful efficiencies built into the operations. But I think our clear track record over the last 3 years has shown our ability to do that, and we'll continue to do that. Obviously, we'll get some further capacity with the expansion down in Brazil. That's going to take a little bit of time. A little bit of that will come on as we get the scalpel put in this year. But overall, you need to think about, kind of overall capacity around 3,400 KT on an annual basis, assuming that everything's running extremely efficient and no significant unplanned downtimes, which we've avoided for a number of years now. So we feel confident in our ability to get to these levels that you're seeing out of our assets, and we'll continue to strive to get more in the future.
Great. And then just following up on that on slide 6, just looking at the different shipment growth trends in fiscal 19, you kind of moving around the mix. How should we think about that for 20? Would that kind of balance out, or is it still be aligned with those growth rates?
Yeah, I think what I would signal is we're still very confident in auto growth on a global basis. Here in the U.S., we still see single mid-teen growth rates and a lot of opportunity. Obviously, the thing with auto is we're running near our capacity levels, though, and obviously that's why we've put in or started the 2 expansion projects, one in Guthrie and one in Changzhou, China. So I think you'll see muted, some increase, but muted increase in auto in this year, with more to come as we qualify those assets down the road. As it relates to CAN, huge opportunity that we've seen in fiscal 19. We see that same trend continuing in fiscal 20, and are there to support our CAN customers with that growth. We do believe in the sustainability, infinite recyclable package that I think is really trending well in the marketplace with consumers. And so I do think we're going to continue to see some growth in CAN in fiscal 20. Can't predict exactly what we'll see there at this point in time, but I think strong growth, especially compared to more historical numbers that we might have had. And then, as we've said, we're capacity constrained, so we're going to have to prioritize around specialties and where we want to play there based on what makes the most sense for us on a regional basis, a product basis, and customer basis. Do you have anything more you want to add there?
No, I think that's really what the point is. And if you want to think about the portfolio mix, Jeff, what you should see is really CAN and auto becoming significant parts of the portfolio as we go ahead in time, while in specialties we think that, to Steve's point, we will be making choices. So bottom line, our priority will be to support can, and auto.
Right. Okay. And then just lastly, and I'll turn it over. On the regulatory side regarding the Alaris merger, the European Commission expressed concerns around the market share for ABS. Curious if this becomes a real hurdle, and it appears to be pretty difficult to part ways with one of the mills. Does this become a deal breaker? How do you think about mitigating that?
Yeah, so, overall in the regulatory process, we made very good progress and received a number of regulatory approvals, including CFIUS approval earlier this calendar year. We do have 3 jurisdictions from an anti-competition standpoint left to obtain, which is U.S., European Commission, and China. And we feel comfortable that in all 3 jurisdictions that we'll receive full clearance. We think we have strong arguments as it relates to competition specifically against steel, and remain confident to close the transaction in the third quarter of this calendar year.
Okay, thank you.
Thanks, Jeff.
Thank you. Our next question comes from the line of Matthew Fields from Bank of America Merrill Lynch. Please proceed with your question.
Hey, everyone, and congrats on the quarter as well. I know in previous years you provided the mix of shipments between beverage cans, specialties, autos. I think 61% beverage can last year and 20% auto. Do you have those numbers for fiscal 19?
All right. So for fiscal year 19, we had 20% mix of auto, which is flat to fiscal year 18. And in Q4, the mix was 19%. Now, can, as you have observed, has grown in the mix compared to our earlier expectations because of all the things that Steve said about the very nice market conditions. Q4 was even stronger at 64%, and there is some seasonality element there about when customers buy, between Q3 and Q4. Specialties shrank to 17% from 20%. Q4 was also 17%, and as we alluded to earlier, that you should see some choices on the specialties side, so we will prioritize automotive and can in the mix. That's the guidance we can give to you.
So for the full year, can was 63%?
That is correct.
Okay, great. Thank you. And then in the can sheet market, obviously we're seeing tightness, and everyone's talking about tightness. Can you give us a little guidance on the cadence of your contracts and when we can see maybe some increased realizations and margin conversion from the can business, and if that's offset by an increased production of body stock versus the more profitable end in tab?
All right, so let me take this one, Matthew. So we are contracted for the foreseeable future, and therefore we do not expect any lift on the prices for the time being. We cannot obviously give you precise details about our contracting periods. The one thing that we can assure you, and we have been saying this in some ways earlier, is that we have got over the recent valley in the last 2 to 3 years on price pressures on can. We think that we are in stable to, sort of optimistic conditions when it comes to the next round of negotiations on can. We cannot promise there will be anything dramatic, but we think that, there could be some opportunity there in the tightness of the market conditions as you observed.
Okay, that's helpful. Thank you. And then, we're hearing, further just this sort of capacity tightness in can. Do you think that even if you are able to kind of produce more sheet, that there's enough capacity from the can customers, the Rexam, Balls, Crown, CCRs of the world to assemble the cans, or is there additional capacity investments needed on their end to assemble all this can sheet that might be coming? Like, is that the bottleneck?
Yeah, I don't think I want to speak for our customers and where their capacity sits and their constraint sits. It's probably more appropriate for them to address. I'm sure you will address with them. I think overall, we're seeing positive trends right now, and I think what we need to do as an industry is make sure that aluminum as a package of choice versus other materials such as plastic becomes understood more readily throughout a consumer base for true infinitely recyclable beverage cans. And that opportunity could be one that we could see tremendous growth over the next, 5 to 10 years. But I think that one's still in the early stages of developing and understanding where those trends are ultimately going to go. But we certainly are going to work with our customers to ensure that aluminum is fully understood through the supply chain and its benefits versus other packaged materials.
Okay, great. That's helpful, Steve. I appreciate it. And then I might have missed it, and I apologize, but $700 million capex for 2020. Can you give us the breakdown of kind of maintenance versus the areas of growth in Guthrie and China and the other sort of growth investments?
All right. So the maintenance capex is going to be 200, which is the number that we have always been guiding everybody to. A big part of the remaining $500 million is really the three projects, and this is going to be a peak capex year, really, because after this, capex numbers will come off as we get nearer to commissioning the project. So really, you should take this in short as a peak capex year. So most of the remaining $500 million is towards the three big projects. Now, there are some other things that we are doing in terms of, R&D innovation, for example. We are investing in digital technologies, and there is some capex towards that. So there is a lot of, and customer solution centers to a small extent. So it is really behind either more innovation or, for the most part, the large projects that we were talking about. Okay,
great. Thank you. And then last one for me, just, on the transaction front, appreciate the commentary on the regulatory confidence. So I know you're willing to divest up to, I think it's $1.2 billion of 2017 baseline revenue. Are you confident that you won't have to divest any assets to gain antitrust approval?
Here today, we are confident that we will not have to divest anything to obtain clearance from regulatory bodies.
All right, great. Thanks very much.
Thanks, Matt.
Thank you. Our next question comes from the line of Rajesh Lakhani from HSBC. Please proceed with your question.
Yeah, many thanks for the opportunity and congratulations for a strong set of numbers. So my first question is basically on the shipments. So Steve, you mentioned that your capacity is 3.4 million ton, but if I annualize the Q4 volumes, we are coming to around 3.5 million ton. So is that something we can achieve easily? Novelis was operating at higher than 100% capacity utilization, which can be done going forward as well?
Yeah, no, there is seasonality. There's bill to finished goods that impacted this quarter, and so there's many other things. And so what I would guide to is the annual run rate of 3,400. There'll be peaks and valleys. We're going to continue to try and get everything we can out of our assets as we have over the last 3 to 4 years, and have been successful. So we're going to do everything we can to get above that 3,400, but right now I think that's the right level to be thinking about as it relates to our capacity on an annual basis. Don't take this quarter and put a run rate on it for many reasons. And so, as I said earlier, Brazil will come on. We'll get a little bit of capacity this year on that. We'll get more capacity from Brazil in later 2021. And we'll continue to find other opportunities through debottlenecking and other ways to get more capacity. But the general guidance that you should be thinking about is the 3,400 on an annual basis.
Understood. And the second question would be on the EBITDA per ton. So we have reported EBITDA per ton of around $410 USD this quarter. But if I look on a regional basis, it's basically the U.S. which has performed extremely strongly, while the other regions have reported a Y-on-Y drop in EBITDA per ton. So just want to understand what was the reason why U.S. performed so well and the other regions underperformed.
All right. So, Rajesh, the reason why U.S. performed so well is because the market conditions in U.S. are supporting us across all the segments, i.e., can demand is robust. On the auto side, all the platforms that we supply to are doing very well, i.e., Ford F-150 as a flagship example. On the specialty side, because of all the happenings from anti-dumping duties on the trade side, it is creating some nice conditions on pricing as well as demand. So this is the reason why North America is doing well. Now, why are the others dropping in Europe? Let me give you some quick headlines. In Europe, we had currency impact, because of the weakening euro. So that was one of the reasons. The other reason is that one of our key customers in Europe is going through challenges on the auto side. So it does worsen the mix a bit. Also because this is one of our nice accounts, and there is some timing coming from the point that Steve made earlier, that when you have an inventory reduction in a quarter, what happens is that some of the costs get absorbed from the inventory. When you reduce inventory, the fixed costs that are sitting in inventory impact you for the quarter. So it's a timing of cost, to put it simply. The reasons are broadly the same in Asia, almost the same that I mentioned for Europe, and also on South America, it was really the only one thing, the inventory change, which resulted in a higher cost absorption. So in short, one can call it timing of cost. So these are really the reasons. So overall, we remain robust, and to the point that you observed the $410 EBITDA per ton, we have been constantly saying for the last few quarters that above 400 is a level that we can sustain, and we stick to that.
Thanks for that elaborate answer. And the last one, if I may, the auto margins are quite strong, and as you have been highlighting, the demand remains quite strong. So I just want to understand, apart from Novelis, are there any other companies which are coming up with capacities and that might impact our margins going forward?
Yeah, so I think that's a complicated answer because there's many various competitions across the world, both in steel and aluminum that we compete in. If you're referring more specifically to aluminum, there's a number of facilities that have come up in Europe over the past year or so that are commissioning and qualifying their materials. Obviously, in the U.S., Aleris has a newer facility in Lewisport that is now in the commissioning, more than commissioning, but selling phase, but ramping up to full capacity. We have announced our Guthrie expansion of 200 KT in the U.S. Arconic has announced some expansion in the U.S. as well as it relates to their Tennessee facility that will have some auto capability. Brady. So it's very difficult to go region by region. There's certainly robust competition, and we feel very good about our ability to compete and innovate alongside our customers to find them the right, solutions and sustainable solutions for their applications on their vehicles, and feel pretty confident about that.
Understood. Thanks a lot.
Thank you.
Thank you. Our next question comes from the line of Matt Vitoriso from Jefferies. Please proceed with your question.
Good morning. Most of my questions have been answered. Great work on the shipments. Maybe just a quick question on the expected sort of credit profile pro forma for the Aleris acquisition. I think in the past you've highlighted something around 4 turns of leverage or just inside of 4 turns of leverage at the close. I see Aleris reporting pretty solid first quarter results. You guys have sort of outperformed our expectations, at least in this quarter. Do you still expect that same kind of level of closing leverage given seems like both Aleris and Novelis are performing well at this point?
Yes, I will stick to our earlier message that we will stay below 4 at peak on transaction close, and within 2 years of the close of transaction, we will come down to levels below 3. We kind of see the results that Aleris has declared for the quarter, and our own delevering has been proceeding a little better than what we have said earlier. So we remain optimistic, but at the same time, for the moment, I think we stick to the guidance that we gave you earlier.
Okay, great. Thank you.
Thank you. you. Our next question comes from the line of Amit Dixit from Edelweiss Financial. Please proceed with your question.
Thanks for the opportunity and congratulations for a good set of numbers. My first question is, what would be the cumulative capex for the 3 growth projects that you mentioned?
The latest capex, cumulative capex for as far as Cardinal is concerned, our capex is about $300 million. As far as China goes, it is about 180, and a very similar number for Brazil. So the total is about 600.
And this will be spread through to 2021, calendar year 21, if I'm not mistaken.
Pretty much. It's up to 21.
Okay. A simple bookkeeping question. When I see the cash balance at the end in the cash flow statement, that doesn't somehow tally with the balance sheet. Maybe I'm missing something on cash and equivalents. Can you please clarify that?
Let's do this. If I can tell Megan Kokard, our head of investor relations, to get back to you on that question. So let's proceed for the time being, if you don't mind.
Oh, sure. Perfectly fine.
It's an accounting question. It's an accounting question, and we will get back to you. I can assure you that the numbers are absolutely robust, and we can come back on the reason.
No problem at all. See, one of the things that has been kind of, bothering us is kind of auto outlook. Now, I can see from the numbers that you are kind of relatively, or rather unimpacted by the auto headwinds. Can you give a guidance on auto shipment for the next year? Of course, you have mentioned that the proportion is broadly expected to be the same. But what kind of traction do you see in the U.S., in China particularly, where auto outlook is particularly weak?
Yeah, let's start. So, as you heard earlier, because of our capacity constraint, we don't see a significant increase in shipments as we go into fiscal 20 for auto. That doesn't mean that the markets aren't robust. We're continuing to put more capacity in to get there. Let's start with 2 questions on North America and China. North America, we feel very good, and you've got to be very careful to just look at overall SAR builds when you start to think about the impact to Novelis. And so while SARs on a year-over-year basis might have declined, they are declining in vehicle models such as sedans that do not have as much aluminum content on them. And actually, the larger vehicles, whether it be the pickup trucks or SUVs or other larger models that have more aluminum on them, are actually increasing. And so we see continued favorable market trends in the U.S. associated with auto through fiscal 20, and remain confident in the models that we're selling into being strong sellers in the marketplace, whether it be the Ford F-Series, which has been the number one selling vehicle in the U.S., number one selling truck for decades now, whether it be some of the new introduced SUVs that have more aluminum on them now, or close to being aluminum intensive vehicles. So we feel actually quite good about the market position in North America. In Asia, or specifically China, absolutely correct. We saw in the second half of our fiscal year some pullback in overall sales volumes there. It has impacted us. I will say that, when you start to look at our outlook there as it relates to recovery, we do not see this as a prolonged pullback. And we also see, the government pushing more and more into, electric vehicle platforms to push forward there and see tremendous growth in that area, which many of those will require significant aluminum content on them. So overall, we see recovery in China. We see good, medium to long-term trends as it relates to, the type of vehicles that we'll be serving inside of China as well. So we stay confident in, our investments that we're making on track to begin the commissioning of our U.S. line at the end of this fiscal year and our China line in 21.
Thanks a lot for the elaborate answer, and all the best.
Thank Thank you.
Thank you. Our next question comes from the line of Ashish Keriwal from IDFC Securities. Please proceed with your question.
Yeah, thanks for the opportunity and many congrats for the good set of numbers. So my question first is on the capex, which you mentioned that the three main projects, which has a cumulative capex of $660 million. So how much we have already spent in FY19 on that?
So you can see the capex outflow at a total level in the cash flow slide that we presented, and you can see that we have spent about 351 million versus the 226 million in the earlier year, and for the most part, this additional capex, almost for the entire part, this additional capex that you see is on these three projects.
So, because when you are talking about that FY20 out of $700 million, around $500 million, or you can say more than $450 million is related to these projects. So, is it safe to assume that in FY21, this 450 can become 150 type?
Yes, broadly.
Okay. And secondly, sir, you have given a mix of fourth quarter in auto, beverage, and specialities. Is it possible to give the similar mix for last year, fourth quarter?
Last year, fourth quarter, so auto was flat, and I think that can would be around 61%, but give me a moment. Yes, so can was 61% last year. Auto actually was 20, and specialty was 19.
Okay. So is it safe to say that the 8% volume increase which we have seen in volumes this quarter, that's entirely driven by beverage can?
Well, so beverage can is really the big driver. In fact, the growth of beverage can has been even higher than that. And you have to be careful to not draw too many conclusions by one quarter. That's the only caution that I want to tell you, because there are timing impacts. I mean, just because this quarter had a significantly higher beverage can growth doesn't mean that it's an underlying growth. There are timings between quarters. So I really think that if you want to draw some conclusions, I think that can mix will look above 61 for sure, which is a historical level, which we have been generally seeing. Can in the mix will look a little higher than that. That is fairly safe to assume. Auto will stay around this level until the time more capacities come up, and specialties will help us to balance capacity to meet the other two. I don't think we can tell you more than that.
That's fine, sir. That's elaborative. And lastly, is it possible to give some kind of volume guidance in FY20? I assume that we have said that 3,400 KT is our capacity. So is it possible to achieve this 3,400 KT in FY20?
No, we will certainly not achieve 3,400 KT, because remember, the 3,400 KT is like a theoretical capacity which assumes that nothing ever happens, and real-life events happen. I mean, we had a transporter strike in Brazil, because of which we were disrupted on our production, and so there are some real-life events that always keep happening. So we would be a little cautious on that, and remember that, we are no longer plucking low-hanging fruits now, because to get to now higher levels of production, we have to keep pushing harder, much harder than earlier, on improving recoveries, on sort of really being able to do some rebalancing of capacity, some debottlenecking here and there. So all in all, I certainly think that we have some volume growth opportunity as we go forward, but it is not going to be dramatic. And then we are waiting for some new capacity to come up, like the South American and the Brazilian capacity, which will then help us to add another 100 KT. So this is how you should broadly think about the future.
Okay. Thank you, sir, and all the best.
Thank you. Thank you.
Thank you. Our next question comes from the line of Ashutosh Somani from JM Financial. Please proceed with your question.
Thanks for taking my question. So my questions are very specific. On the customer side, without having to name customers, if you could just tell us, the top 2 customers account for what percentage of our automotive sales?
Yeah, we can name those. We've named them in the past. Our 2 largest customers are Ford and Jag Land Rover. So Jag Land Rover in Europe primarily. We also sell to them in China. And then Ford mainly in the U.S., although there would be some sales in both China and Europe as well.
So what percentage of our automotive sales come from these customers? These 2 customers is what I want to know.
Yeah, we don't break it down into those kind of specifics with our contracts.
Correct. And the second aspect is, this again is a historic question. So when did we last renegotiate our prices, automotive sheet prices with our customers? If you can share that.
Yeah, we're continually, we're signing new contracts every quarter with auto customers across the world. So we're in continuous negotiations on the auto side.
Okay.
Typical auto length of contract.
I think before data is...
Once we've signed a contract or negotiated, it's typically for the life of the vehicle. So that's typically somewhere in the 5-year range.
Sure. Okay. Thanks for answering my question. Thank you.
Thank you. Our next question comes from the line of Indrajit Agarwal from Goldman Sachs. Please proceed with your question.
Hi, good morning. Can you give us some sense of the scrap spreads this quarter and how they compare with last quarter, and what is the kind of spot spreads that you are seeing in that market?
Yeah, I would say a little broader than this quarter and last quarter, but let me try to throw some light on how we see spreads. So the one region which has been very consistently at a very nice level is North America. It is all public information that the supply of scrap, for the time being at least, and even in the foreseeable future, in the U.S. is in our favor. So the positive supply versus demand conditions are continuing to show us some favorability through the year and even looking forward. Now, as far as South America is concerned, compared to some peak levels that we saw in the earlier to the middle part of calendar 2018, are kind of, sort of moderating a bit, still at healthy levels compared to historical spreads that we saw, but they have come off a bit. And a part of that is because there are others competing for the same scrap, like some of the auto guys in Brazil are also competing for the same scrap. So there is a bit of rebalancing there. In Europe, it is generally steady. A little coming off, but not very dramatic. I would say similar for Asia. What we saw in the earlier part of the last calendar to the mid of last calendar, we see some bit of moderation there. But having said that, the market conditions still remain healthy. And you have to think about it in 2 parts. What is really what's not really helping us for the time being is the metal prices coming down. So with that, spreads get compressed. So that is what is really impacting us for the most part, while in general, supply conditions remain pretty okay to good.
Thanks a lot. That answers my question.
Thank you.
Thank you. Our next question comes from the line of Vishal Shandak from NK Global. Please proceed with your question.
Yeah, thank you very much for taking my question, Mr. Gaurav. My question is with respect to this Aleris acquisition. Is there any geography where we have received the approval, and if you could just give a breakup between the key geographies where approvals are pending?
Yeah, so we've received a number of approvals through geographies that we are selling our product into, and Aleris selling their product into as well. I couldn't go through the list of all those right now, so I'll focus more on what's left to go. And the 3 that remain to get clearance from is the U.S., European Commission, and China. And again, we expect to get the clearance from those jurisdictions and close the transaction in this calendar third quarter.
Got it. Secondly, in terms of your EBITDA per ton differential, if you could just give some color on the differential between your beverage can and the automotive EBITDA numbers. So just some color just to build in case you're shifting.
We don't give those numbers out. I can only talk, as I already did earlier, at an overall level. So the best that we can tell you is that, the product mix that we mentioned to you, and on top of that, we think that plus minus a bit every quarter, 400 plus per ton is a sustainable, nice level that we will continue to deliver.
Got it. Thank you so much.
Thank you. Our next question comes from the line of Pinakin Parekh from JP Morgan. Please proceed with your question.
Yes, thank you. Two questions. My first question is, while you would not give the packaging, the can contracts resets, but you did highlight that one can be optimistic about the potential pricing. Can we see any of the benefits in FY20, or you think that any benefits from any resets is more from F21 onwards?
So I think that the benefit that we will see in FY20 will be on the volume side because of everything that you heard from Steve earlier. We do not see anything significant. There could be some spot opportunities in some cases, where customers want to go above contract levels, but you should not expect to see anything meaningful or dramatic in fiscal year 20 on the pricing side in can. They will be steady to a little betterment.
Understood. My second question is, the outlook on the margins and how should we look at it in the context of LME aluminum prices? They have broken down below, critical support levels of $1,800, and if we were to reset to $1,700 per ton and lower, can we still expect 400 plus margins to sustain for Novelis, or you think that given the indirect relationship, lower aluminum prices can drag down the overall margins for the company?
No, look, you have seen what the metal prices have been in this quarter, and they have not been at any great levels, and despite that, we delivered an EBITDA of $410 per ton. So that tells you. So what is helping is that the supply conditions are in our favor, so that gives us a bit of an offset. But we have a number of things that we are working on. Our business is not just about scrap spreads. We are working on quality. We are working on efficiencies. We are working on safety. We are doing a number of things which inherently help us to continue growing the EBITDA. Now, depending on where the scrap spreads go, there could be some moderation happening as an offset to that, but we don't just keep watching scrap spreads all the time. We have other levers that we keep working on.
Understood. Thank you.
Thank you. Our next question comes from the line of Carl Blunden from Goldman Sachs. Please proceed with your question.
Hi, good morning. Thanks for the time. Question on the U.S. automotive market. Obviously, a lot of people see it as an attractive market to be in. Have your planning assumptions around market supply demand changed at all with the Brady Industries JV news with Rusal, and do you still expect the market to be sold out based on all of the announcements that you've seen today?
We certainly watch the competitive landscape and have seen the recent announcements with Brady and Rusal. And, at the end of the day, as I think you can see from ourselves and a number of other suppliers to auto customers in the marketplace, it does take time. It takes time to get to the levels that these OEMs expect you to be at. And so I wouldn't, while we need to take Brady seriously, I wouldn't factor too much in the very near term as it relates to significant capacity coming into the marketplace from that particular facility itself. And again, what we're going to strive to do at Novelis is continue to innovate and continue to find those right engineered solutions for our customers to compete against steel, so that we can continue to produce and provide solutions that make these vehicles perform better, and that's what we'll stay focused on at Novelis.
Gotcha, that's helpful. I'm not sure how much you could say on this next point, but similar vein, on the steel side, we've seen a lot of capacity announced, right? Most of it's towards the lower end of the market, not going to compete directly with aluminum, but you've had some now, and recently, about a week ago, U.S. Steel announcing an upgrade of the Mon Valley facility, which will take a couple years, but is targeted towards advanced high-strength steel. Have you seen any, do you see that as an inflection in the competitive landscape, or just kind of normal reaction to the opportunity that's out there?
I think it's normal reaction in that steel sees aluminum and our innovative solutions as a threat, and they're going to compete, and they're going to find ways to continue to innovate themselves. And I think that's the battle we have in front of us over the next 5 to 10 years, is to continue to find ways to make our alloys stronger, lighter, more formidable, ability to join with other materials as OEMs will most likely be looking at more mixed material type vehicles. And so I think it's not unique. It's, I think, just what we've experienced as we've come into this in a bigger way is the back and forth competition that we see with all materials, and specifically steel.
Gotcha. Thanks very much. Appreciate it.
Thank you. Our last question comes from the line of Sean Wondrak from Deutsche Bank. Please proceed with your question.
Hi there, and congratulations on a very strong fiscal 2019.
Thank you.
I think earlier in the call you had mentioned that I think you're entering the battery enclosure solutions market. Is that right? And what do you sort of see in terms of prospects, the size of the market? And, I know you noted earlier there are a lot of applications for sort of EVs that could be out there as the Chinese market and other grows. Are there other sort of, applications like this that you're looking into? Thank you.
Yeah, so, it's exciting to announce the battery casings. It's, very innovative, the first rolled product, the aluminum solution that can provide the same strength needed. So then, what that does is allow more battery to go into the casings, which allows for more distance on the electric vehicles. And so we think it's a strong offering. And we think that as we look at, where the market's going to go, we expect, the battery electric vehicles to triple by 2025. So it's hard to tell you exactly today what that might look like, but these are the innovative pockets that we'll continue to put out there for our customers and work with our customers to develop these. So more to come specifically on that one. But this is exactly what we're doing with our customer solution centers, is changing our mindset to really work with our customers early on in vehicle designs to find solutions together to allow vehicles to perform at better levels. And we're seeing traction with the 3 customer solution centers already. This is a great example. More to come as it relates to other specific product launches, whether it be specific alloys or other elements with the vehicles.
Gotcha. And are there any barriers to entry that we should think of, about that market? Is that an easy market to enter, or do you need to qualify with the OEMs who are actually making the batteries? How does that work exactly?
Yeah, no market's easy to enter, and certainly we'll have to go through all the process of qualifications with our with customers that will look for these solutions. But we've done, obviously to get to the point to launch it, we feel very, very good about the specs and capabilities of this, and so we think that as we work through those processes with various OEMs, that we'll be able to help them understand the benefits here.
And am I right to think that it's likely margin accretive to the sort of 400 a ton that you've been mentioning on the call?
Yeah, I think we've generally talked about auto products being some of the better margin products that we have in our portfolio, and this one would certainly fall into that category too.
Right. Appreciate that. And then it's sort of along the same vein, but you were talking about your customers earlier and the typical life of a vehicle being 5 years. When you have an emerging product like this that's beginning to take a share from the market, how does it work in terms of pricing? Are there sort of built-in price increases? Are they indexed? As your quality improves over time, are you rewarded for that? And again, if you can comment on some of the barriers to entry once you've won a platform or won a contract, that would be really helpful. Thank you.
Yeah. Now, are you specifically asking around the battery casing, or are you talking about in general now aluminum rolled products going into auto?
Aluminum rolled products in the auto.
Yeah. So as I said earlier, typically, we're competing in early stages for the material choice on the vehicle itself, which can be 3 years before the product launches itself. Then typically part by part is awarded for the life of the vehicle, which typically is about 5 years. And in those contracts, we have certain set terms and conditions as it relates to volume, take minimums and maximums typically. And that would be the typical contract, that we would enter into across the world. I would say that, what we see with electric vehicle companies is a more rapid pace of development as it relates to these new or innovative solutions that they would be willing to test and qualify onto a vehicle midlife of a vehicle kind of platform. And so that's why this one we think is a unique one in that with the significant weight savings that they could find with the same strength properties that they need to get more battery onto it sooner is something that we think our customers would be open to considering even in the middle of a vehicle life.
Right. And once you've won that contract, say it's 5 years, are you basically sort of immune from competition, or could you lose that contract effectively?
Well, I mean, once you're awarded a contract, it's our contract, and obviously we have to continue to service that contract with the right quality product, within the parameters that are in the contract. But typically, we would not have that percentage or part of a vehicle taken away from us. We've not seen that in the past once we've actually started to deliver the product.
Great. Thank you. That's helpful. And just one last one. Just as we think about fiscal 2020, have you commented on working capital or cash taxes for this year and what we should expect sort of going forward?
All right. So I can tell you what to expect there. So as far as cash taxes is concerned, you should expect cash taxes to go a little above 200. One of the reasons why cash taxes will go up is that we will be fully utilizing our NOLs in the U.S., and that means that we become cash taxpayers. And the other reasons for the tax increase would be generally, some of the things that happened this year on a one-time basis. We got a refund through a tax litigation in Asia. That's about $7 million. That will not repeat again next year. So through a combination of the fact that we have exhausted using our accumulated tax losses in the U.S. and also some of the one-timers not recurring, we will have higher cash tax. One more important thing that what helped us in fiscal year 19 to have lower cash taxes than normal was that there was a tax audit settlement for one of the old litigations in Europe where we thought that we will pay in fiscal year 19, but that outflow has got postponed to fiscal year 20, and that's not a small number. That's a number in the region of around $15 million. So that is the reason why you should expect the number to go to $200 million on the cash taxes. Your other question was around working capital?
Yes, thank you.
So on the working capital, here is what I would say. I think that on an underlying basis, we think that we can work with flattish working capital into next year by driving efficiencies. Having said that, you'll keep a watch on the metal prices because every $100 move in metal price has an impact of about $50 million on our working capital. So who knows where metal prices are going to head towards the end of next year. So that's the only factor that you need to keep in mind.
Gotcha. That's very helpful. I think that's it for me. Thank you. Good luck.
Great. Thank you.
Thank you. There are no further questions at this time. Mr. Fisher, I'll now turn the call back to you. Please continue with your closing remarks.
Great. Thank you. And thank everyone that joined us today for a little bit lengthy call. But I just want to end the call here where I began it by thanking our employees and our customers for helping us achieve record financial and operational results in fiscal 19. As you can see, this is a unique and important time in the company's history, and I believe we're making all the right strategic investments in capacity, customer service, and innovation to position Novelis and our customers for long-term sustainable growth. So look forward to speaking with you and updating you again in another quarter. So thank you again.